Hello, my name is Jack Elder, Senior Director for Advanced Planning with Comprehensive Brokerage Services. Today, we're going to talk about the estate tax and the four ways your clients have to pay the estate tax. So, quick background. The estate tax, current estate tax is a little over $12 million for a single person, $24 million for a couple. It increases by inflation approximately 2%. In 2026, it is scheduled to sunset and drop to half of that. So, projecting out, in 2026, the estate tax exemption looks to be about $6.5 million per person or $13 million per couple. That means a lot of families under today's tax laws are going to be subject to the estate tax. Well, what does that mean? It means that you take the total value of their net worth, you subtract the estate tax exemption, and the rest is subject to a maximum rate of 40%. Let's take an example to see how a family could pay that estate tax. So meet the Martins. Let's assume they're both age 65 and they have a current net worth of $20 million. Let's assume we grow their net worth at 4.5% for their joint life expectancy, and I'm pulling these life expectancies from the IRS longevity tables. So if you grow their estate at 4.5% for the next 23 years, their projected net worth at the death of the second of them is around $55 million. The projected estate tax at that time, based on the laws on the books today, looks to be just under $15 million. $14,448,354. So what we're going to talk about is how can the Martins pay that tax? What happens mechanically? Where do they get the money? How much time does their personal representative have to pay the government? Essentially, there's four ways to pay the estate tax. There's cash on hand. There's the sale of family assets to convert to cash. You could finance that debt with the government, either with the government, depending on various factors, or with a third-party bank loan, or you can prepay using discounted dollars. When someone passes away, they have 9 months to pay the estate tax, plus a 6-month extension. So the clock is ticking. The family has 15 months, 9 months plus 6-month extension, 15 months to pay the estate taxes. So let's look at the cost of each one of these approaches. Cash on hand, that's simple. It costs dollar for dollar, 100 cents on the dollar. The family's going to have to part with almost $15 million within 15 months. If the family doesn't have the cash, and let's say they have assets, the clock starts ticking right away. They've got 15 months to convert their assets to cash. Depending on the nature of the assets, the timing, they might be selling those at a discount. So if you're selling, stock or real estate or other assets at a 90% discount, that essentially means you're paying 111 cents on the dollar. The deeper that discount, and who knows what the future holds, we're talking 23 years from now. So if the Martins were heavily invested in real estate, that could be really painful. If they own other illiquid assets, if they have 15 months to unload them, you could be in a fire sale situation where they're selling the asset for 70% of what it's worth, which would cost them 143 cents on the dollar. Next option, they could borrow the money, assuming the estate qualifies. I just took that 14 million and change. I applied a 5% rate over a 10-year term. The actual cost due to the interest is $18,880,000 or 128 cents on the dollar. That leaves us with what is their best plan, which is using discounted dollars. And that's prepaying their projected estate tax liability with life insurance. In this case, the cost is 22 cents on the dollar. If they pay a level pay premium over their joint life expectancy, minimum fund the contract, their total out-of-pocket cost would be about $3.2 million, which is only, it's only 22 cents on the dollar. So looking at their four options to pay the estate tax: one, cash on hand, costs you dollar for dollar. Both forced liquidation or using third-party financing is it costs more, substantially more than the tax itself. But if they prepay their estate taxes with life insurance, you're only talking 22%. And oh, by the way, in this case, at their joint life expectancy, the internal rate of return on the death benefit is 9.1%. And if they had extreme longevity in their family, let's say they both lived to 95, the internal rate of return is still 6%. So not only is this the smartest way to cover the inevitable estate tax liability, it's also a very good investment. So we can produce for you a very nice deliverable that it provides the four ways that your client can cover the estate tax, including customizing their specific situation, because now is the time to discuss prepaying the estate tax with your clients. There's no time to wait. The longer you wait, the more the insurance will cost. So be prudent and let's have this conversation. We'll provide you with this nice customized deliverable to guide that conversation. Please feel free to reach out to us. I can be reached directly at 301-768-8784, or you can email me. You see my email address there. We would love to work with you and help you and your clients address their concerns.